Hey everyone, and welcome back to the Safe, Simple, Sound podcast, Tax Edition. I'm your host, Alex, and I'm thrilled to have you join us today as we tackle a topic that's fundamental to seizing financial control, understanding your wages, salaries, and how they're taxed. Remember, at Safe, Simple, Sound, that's our first core belief. Today's episode is based on information directly from IRS Publication 17, a comprehensive resource for understanding your federal income tax. This publication, and therefore this episode, breaks down the essentials of reporting your employment income, and it's incredibly relevant whether you're just starting your first job, navigating a career change, or even enjoying retirement. Now, this isn't just about paychecks. Publication 17 highlights some crucial points that really resonated with me. First, it emphasizes that all income, even if you don't receive a Form W-2, must be reported. That's a big one. Second, it clarifies the often confusing world of employee benefits, separating the taxable benefits from the non-taxable benefits. And third, it provides really helpful guidance for those in special employment situations, like our valued military personnel, clergy members, and childcare providers. So, get ready to embrace mastery of your cash flow, as we say here at Safe Simple Sound, by understanding where your money comes from and how it's taxed. This episode is packed with practical information to help you file your taxes accurately and confidently. Let's get started. Think of your W-2 or wage and tax statement as your financial report card for the year. It's that crucial document your employer sends you, summarizing everything you earned and all the taxes that were taken out. It is essential for you to be able to accurately complete your Form 1040 or Form 1040 SR. This might sound intimidating, but trust me, once you break it down, it's much more manageable than you might think. We'll cover everything from what those mysterious boxes mean to what happens if you don't receive a W-2. So, first things first, what exactly is a Form W-2? It's your annual wage and tax statement. Your employer is legally required to send this to you, usually by the end of January. It's a summary of your earnings for the previous year and, importantly, details all the taxes that were withheld from your paychecks. This includes your federal income tax, Social Security tax, and Medicare tax. Think of it like a receipt for your entire year's work from a tax perspective. You'll need this form to file your Form 1040 or 1040 SR, your actual tax return. Without it, you're flying blind, so to speak. Now, let's look at the most important part. Box 1. This box on your W-2 shows your total taxable wages, salaries, and tips. This is the number, the big one, that you'll use to report your income on line 1A of your tax return. For example, if Box 1 shows $40,000, that's the amount you'll generally put on line 1A of your 1040. It's the starting point for calculating your taxable income. Have you ever wondered where the government gets its information about your income? Your W-2, Box 1, is a primary source. Here's a crucial point, and one that often trips people up. Even if you don't receive a W-2, you are still legally required to report all wages and income you received. Let's say you had a side hustle where you were paid in cash, under the table, and you didn't receive a W-2. Or maybe your employer simply forgot to send you one. It happens. You are still responsible for reporting that income. The IRS doesn't care how you were paid. They care that you report it. Ignoring this income can lead to penalties and interest down the road, so it's definitely not worth the risk. The rule of thumb is, if you earned it, you report it. Now, another potential scenario. Let's say you received a W-2, but your employer didn't withhold Social Security and Medicare taxes, and you're sure you weren't an independent contractor, you were an employee. This can happen, and it's a bit of a special situation. In this case, you'll need Form 899, Uncollected Social Security and Medicare Tax on Wages. This form helps you calculate and report those missing taxes. Think of it as a safety net to ensure you're paying your fair share, even if your employer made a mistake. This highlights an important question. What are some common mistakes people make with their W-2 form? Often, I find that new taxpayers will misunderstand the different boxes, misread the numbers, or simply not know where to find it on their tax return. Another common oversight: if you do not receive a W-2, Many people assume they do not have to report that income, which is far from the truth. To ensure you do receive your W-2 in a timely manner, make sure your employer has your correct mailing address. If you haven't received it by mid-February, contact your employer's payroll department. If that doesn't work, you can contact the IRS directly, and they can help you track it down. So, to recap, your W-2 is your annual financial summary for tax purposes, detailing your earnings and withholdings. Box 1 is your total taxable income, the key number for your tax return. You must report all income even without a W-2. And if your employer didn't withhold Social Security and Medicare taxes, you'll need Form 8919. Your action item for this segment is locate your most recent W-2 or your last pay stub if you haven't received your W-2 for the current year yet. Compare it to what we've discussed. Look at Box 1. Check the withholdings for federal income tax, Social Security, and Medicare, and make sure everything looks accurate. Understanding where these numbers come from is the first step to taking control of your tax situation. And now, let's move on to something that can make your compensation package even sweeter: the world of employee benefits. We'll be breaking down the difference between taxable and non-taxable benefits, which can significantly impact your overall tax liability. Understanding your employee benefits, specifically the difference between taxable and non-taxable ones, is critical. This might sound a little dry, but trust me, it can make a big difference in your bottom line, and even with your financial well-being come tax season. So, what are we really talking about here? Well, your paycheck isn't always the whole story of your compensation. Your employer might offer a range of fringe benefits, things like health insurance, life insurance, company cars, even employee awards. Some of these are like hidden bonuses that don't get taxed, while others do add to your taxable income, ultimately increasing your tax bill. We will be drawing on material from IRS Publication 17 today, so you can be sure that the information is accurate. Getting a handle on this is crucial for accurate tax filing and smart financial planning. Let's dive into the key points. First off, remember that your total compensation often includes more than just your salary. Many fringe benefits are taxable, adding to your overall income. Think of it like this: your salary is the main course, but these benefits are like the side dishes. Some side dishes come with an extra charge, and some are complimentary. Secondly, let's look at some common examples of taxable benefits. These can include things like bonuses, performance awards, and the personal use of company vehicles. That holiday bonus you got? Taxable. That Employee of the Month award that came with a cash prize? Also taxable. If your company lets you use their car for personal errands, the value of that personal use is generally considered taxable income. Now, there are specific limits on the tax-free amount for employee achievement awards. For a qualified plan award, part of an established written plan that doesn't favor highly compensated employees, you can exclude up to $1,600 per year. But for a non-qualified plan award, the limit is much lower, only $400. Anything above those limits becomes taxable. Thirdly, let us consider group term life insurance. This is a common benefit, and it's generally tax-free up to $50,000 of coverage. That's great news. However, if your employer provides you with coverage exceeding that $50,000, the cost of that extra coverage is considered taxable income and will be reported in Box 1 of your Form W-2. It is something to watch for. Now, let's talk about the good stuff, the non-taxable benefits. This is where you get some real tax breaks. Fourthly, these often include your employer-paid accident and health insurance premiums. That's a huge one for most people, and thankfully, it's generally not considered part of your taxable income. Also in this category are what's called de minimis benefits. This is a fancy term for small, infrequent perks that are just too much of a hassle for the IRS to track. Think occasional use of the company copier for personal documents, the office holiday party, or those occasional donuts in the break room. These are generally not taxable. Finally, let's touch on something called non-qualified deferred compensation. This is a bit more complex, but it's important to understand. You might see this reported with code Y in Box 12 of your W-2. Basically, it's money your employer sets aside for you to receive later, often in retirement. The key here is that it's not taxed now when it's being deferred. But, and this is a big but, it will be taxed when it's eventually distributed to you. However, it is included in wages, subject to Social Security and Medicare taxes at the time of contribution. It's like putting money in a special savings account that grows tax deferred, but you'll eventually owe taxes on the withdrawals. So, why is it important to distinguish between taxable and non-taxable benefits when filing your taxes? Well, because it directly affects how much you owe. If you don't account for those taxable benefits, you might underreport your income and end up with an unexpected tax bill, plus potential penalties. And beyond just taxes, how can understanding your benefits package impact your overall financial planning? It helps you see the true value of your compensation. That seemingly small difference in health insurance premiums between two job offers could be a significant factor when you consider the long-term financial implications. Have you ever really looked closely at your pay stub to see how your benefits are listed? Have you ever thought about the tax implications of that company car or that bonus? It's time to start paying attention. To recap, your compensation goes beyond your salary. Taxable benefits increase your taxable income, while non-taxable benefits give you a tax break. Knowing the difference is crucial for accurate tax filing and effective financial planning. So, here's your action item for this week. Review your pay stubs and any benefits documentation from your employer. Identify which benefits are taxable and which are non-taxable, and estimate their impact on your overall tax liability. This will give you a much clearer picture of your financial situation and help you avoid any surprises come tax time. Now we're going to explore some special employment situations and how they impact your income reporting. Think of this as the exceptions to the rules section of your tax life. While most of us have relatively straightforward W-2 income, there are certain professions and circumstances that come with their own unique set of tax considerations. We'll be looking at clergy, military personnel, childcare providers, and those working for foreign employers. So why are these situations special? Well, it's because the standard tax rules don't always neatly apply. The tax code can be complex. These categories highlight some of that complexity, showing how seemingly simple concepts like income can get a bit more nuanced. Let's start with our first key point: clergy. Now, if you're a member of the clergy, an ordained minister, priest, rabbi, imam, etc., you likely know that your tax situation is a little different. One of the biggest differences revolves around housing allowances. Often, a portion of your compensation is designated as a housing allowance, and this can be excluded from your gross income for federal income tax purposes. Sounds great, right? It is, but here's the catch. Even though it's excluded from your income tax, it is generally included when calculating your self-employment tax. Think of it like this. You get a break on one side of the equation, but it balances out on the other. For example, if a pastor receives a $20,000 housing allowance, they might not pay income tax on that $20,000, but they'll still need to factor it in when figuring out their self-employment taxes, which cover Social Security and Medicare. Also, any offerings and fees received for religious ceremonies need to be reported. Next up, let's talk about our military personnel. Thank you for your service. If you're active duty or a veteran, you know that your pay comes with various components. Some are taxable and some aren't. Your base pay? Taxable, just like a regular salary. But certain allowances, like those for housing BAH and subsistence BS, are generally not taxable. It's like getting a tax-free bonus to help cover essential living expenses. And importantly, any veterans' benefits you receive from the Department of Veterans Affairs VA, things like disability compensation, education benefits, or healthcare, are generally not taxable. So if you're receiving a monthly disability payment from the VA, that's not something you need to report as income on your tax return. Now, let's move on to childcare providers. Whether you're running a daycare center out of your home or working as a nanny in someone else's, you must report all the income you receive. The key distinction here is whether you're considered an employee or self-employed. If you're an employee, you'll get a W-2, just like we discussed earlier. But if you're self-employed, meaning you control how you do your work and you're responsible for your own taxes, You'll report your income on Schedule C of Form 1040, which is for business income. Think of it this way. If you're setting your own hours, providing your own supplies, and essentially running your own childcare business, you're likely self-employed. If you're working for an agency or a family that dictates your schedule and provides the materials, you're probably an employee. This distinction is crucial because it determines which forms you use and how you pay your taxes. Finally, let's consider those working for foreign employers. This is becoming increasingly common in our globalized world. If you're a U.S. citizen or resident alien, you're generally taxed on your worldwide income. That means even if you're living and working in, say, France and getting paid by a French company, you still need to report that income to the IRS. However, and this is a big however, there are often exclusions and foreign tax credits that can help reduce your tax burden. For example, the foreign earned income exclusion allows you to exclude a certain amount of your foreign earnings from U.S. taxation. It's like the IRS acknowledging that you might already be paying taxes in the country where you're working, and they don't want to double tax you on the same income. These scenarios really highlight the importance of understanding your specific employment situation. The general rules apply, but the details can make a big difference. So, what resources are available to help you navigate these complexities? Well, the IRS itself is a great starting point. Specifically for clergy, check out IRS Publication 517, which is all about Social Security and other information for members of the clergy and religious workers. For military personnel, IRS Publication 3 is your go-to guide, covering armed forces tax issues. For understanding taxable and non-taxable income in general, refer to IRS Publication 525. And if you're dealing with income from a foreign employer, IRS Publication 54 provides detailed information on tax for U.S. citizens and resident aliens abroad. Of course, consulting with a tax professional who specializes in your particular situation is always a wise move. They can provide personalized guidance and ensure you're meeting all your obligations. Key takeaways: certain employment categories have special tax considerations. Housing allowances for clergy impact self-employment tax. Military pay has taxable and non-taxable components, and veterans' benefits are generally not taxable. Childcare providers must report all income, either on a W-2 or Schedule C. U.S. citizens working for foreign employers are taxed on worldwide income, but exclusions may apply. Here is your call to action. If you fall into one of these special employment categories, clergy, military, childcare provider, or working for a foreign employer, please consult IRS Publications 517, 3, 525, 54, and/or a tax professional for detailed guidance. Don't try to navigate these complexities alone. Getting expert advice can save you time, money, and potential headaches down the road. And with that, we're ready to move on to our next segment, where we'll be tackling the often confusing world of tip income. All right, safe, simple, sound listeners, we've just wrapped up a discussion on those tricky special employment situations. Now let's shift gears and talk about something that affects a lot of people: tip income and how to properly report it. Whether you're a server, bartender, hairstylist, delivery driver, or anyone else who receives tips, this is crucial information for staying on the right side of the IRS. We're going to break down the rules, demystify some confusing terms like allocated tips, and give you some practical advice. Because let's be honest, nobody wants a surprise tax bill, or worse, an audit, because they didn't understand how to handle their tip income. First things first, all tips received are considered taxable income and must be reported on your Form 1040 or 1040-SR, along with your wages. Think of it this way: your hourly wage is just part of your compensation. Those tips, whether they're cash, credit card tips, or even non-cash tips like a gift certificate, are all part of the money you earned for providing a service. The IRS sees it all as income, and they expect you to report it. So, how do you actually do that? Well, the second key point is that you are required to report your tips to your employer monthly, who will then withhold income tax, Social Security, and Medicare taxes based on your reported tips and wages. This is usually done through some kind of internal system at your workplace. Maybe you fill out a daily or weekly tip report, Or maybe your point of sale system tracks it automatically. The important thing is that you're communicating to your employer exactly how much you're making in tips. This allows them to withhold the correct amount of taxes from your combined income, wages plus tips. This prevents a big tax bill come April. Now, here's where it gets a little more complicated. If your reported tips are below a certain percentage of your gross receipts, your employer might allocate tips to you. These allocated tips are shown in box 8 of your W-2. What does that mean? Essentially, the IRS assumes that people in tip-based industries earn a certain percentage of their sales in tips. This percentage is usually around 8%, but it can vary. If you report significantly less than that, your employer is required to allocate the difference to you. Think of it like the IRS saying, "We think you probably earned at least this much in tips, even if you didn't report it all." For example, let's say you work at a restaurant and your total sales for the year were $100,000. The IRS might assume you earned at least $8,000 in tips, 8% of $100,000. If you only reported $5,000 in tips, your employer might allocate an additional $3,000 to you, which would show up in box 8 of your W-2. This leads to our fourth key point. Allocated tips aren't subject to withholding, but you must still include them in your income and calculate Social Security and Medicare tax on them using Form 4137. This is a crucial distinction. Because your employer didn't withhold taxes on those allocated tips, you're responsible for calculating the Social Security and Medicare taxes on them yourself. Form 4137, Social Security and Medicare tax on unreported tip income, is your friend here. It walks you through the calculation. And finally, for all the nitty-gritty details, refer to IRS Publication 531 for comprehensive guidance on reporting tip income. This publication is your go-to resource. It explains everything in detail, provides examples, and answers frequently asked questions. It's like having a tax expert on call 24/7 for free. Now, let's circle back to those guiding questions. What are the potential consequences of underreporting tip income? Well, the biggest one is owing back taxes, penalties, and interest. The IRS can audit you, and if they find that you've significantly underreported your income, it can be a costly and stressful experience. It's just not worth the risk. Plus, underreporting your income can also affect your future Social Security benefits, since those are based on your reported earnings. And why is there a system of allocated tips? And how does it work to ensure fair taxation of tip income? It's essentially a safeguard to prevent widespread underreporting. The IRS recognizes that it's difficult to track every single cash tip, so the allocated tip system creates a baseline expectation. It encourages accurate reporting and helps ensure that everyone pays their fair share of taxes. Think about your own tipping habits. Do you always tip a certain percentage? Do you ever leave cash tips? Have you ever wondered how those tips are tracked and reported? It's a good exercise to put yourself in the shoes of someone who relies on tips for a significant portion of their income. So, to recap, all tips are taxable, report them monthly to your employer, understand allocated tips and Form 4137, and use IRS Publication 531 as your guide. My call to action for you is this. If you receive tips as part of your income, familiarize yourself with the reporting requirements and ensure you're accurately tracking and reporting your tips to both your employer and the IRS. Consider using a tip tracking app or spreadsheet. There are plenty of free and easy-to-use apps out there that can help you keep track of your daily tips. A simple spreadsheet works too. The key is to have a system in place. And that's a wrap on today's deep dive into wages, salaries, and employment income. We covered a lot of ground, from deciphering your Form W-2 and understanding Box 1 to navigating the complexities of taxable versus non-taxable benefits, and even tackling those tricky special employment situations like military pay and clergy housing allowances. We also made sure to emphasize the importance of accurately reporting all income, including tip income, and understanding what allocated tips mean on your W-2. I think one of the most impactful takeaways from today, and something that really jumped out from IRS Publication 17, is the crucial distinction between taxable and non-taxable benefits. Knowing whether that group term life insurance or those employee achievement awards are adding to your taxable income can make a huge difference in your overall tax liability. And for those of you who receive tips, remembering to report them diligently is absolutely essential. Thank you so much for tuning in to the Safe, Simple, Sound podcast. I truly appreciate you spending your time with us. If you found this episode helpful, please take a moment to subscribe, leave a review, and share it with anyone who might benefit from this information. It really helps us reach more people and spread the word about safe, simple, and sound financial practices. You can find links to all the IRS publications we mentioned, including Publication 17, in the show notes. And be sure to subscribe so you are ready to seize financial control. Until then, remember to embrace mastery of your cash flow, stay informed, and keep making those sound financial decisions. This is Alex, signing off.